I'm Charlotte McLeod with the Investing News Network, and here today with me is Will Rhind, founder and CEO of GraniteShares. Thanks so much for being here online with me today.
Thank you, Charlotte. Good to be with you.
Great. So let's start by talking a little bit about GraniteShares. You recently reached over $1 billion in assets under management, which I think was led by growth in the GraniteShares Gold Trust. I wondered if you could tell me about the journey to 1 billion and what that rise can tell us about the gold market today.
Sure, yeah, I'd be happy to. So it actually was just under 3 years ago that we were launching the first funds. And we launched, at the time, it was a broad commodity fund that gave exposure to the broad commodity market. And that was sort of an innovation in a way because it was low cost, certainly the lowest cost that a commodity fund in an ETF form had been done before, but also no K1, which is certainly something that a lot of advisors here in the States pay attention to. So that was Com B. And then we launched gold shortly after, BAR, which has really kind of become our flagship fund. And I think a lot of the reasons for that are that, again, we copied the similar recipe, which is we wanted to go into a market that we felt like the management fees were high for what they were, and that at the end of the day, gold doesn't pay any kind of income. And so owning it in a low cost manner makes a ton of sense. And so we launched BAR, was the lowest cost gold ETF at the time when we launched it. And really that sort of helped, propel, I think, the broader interest in gold and the company kind of more broadly. And so we kind of found our spot in the market, I suppose you could say, in the real asset space by launching these low cost core products. And that just timed nicely with, obviously the demand for gold. And that, we started to see the bottoming of that in sort of 2016, 2017, and it slowly increased from there. So I think, we've tried to pay attention to launching good quality products, tried to pick our spots, an area of the market that needed innovated, needs shaking up. And we've been able to really add value to investors from that perspective.
Right, yeah, the launch really did time quite well, I think, with gold's increase over the last few years. What's the path forward for gold in your opinion? I think more and more we're hearing market watchers suggesting it could take out its previous high in the fairly near future. Do you think that's realistic?
I certainly think it's realistic. You've got to sort of think back or cast your mind back to 2008 and what happened there. And of course, I was involved in the gold market at that time. And so going through 2008, running obviously different gold fund at the time, but thinking about what happened then. And in that year, the price of gold went up, price of gold went down, it bottomed out around $700 an ounce. But the average price for that year was somewhere around $850 an ounce. And we forget that, in the 3 years following the crisis, gold went on to more than double in value and made its all-time high, in 2011 at over $1,900 an ounce. So if we think about what happened then and why gold reacted in the way it did, there are a lot of similarities to now. It's just that the situation now is just so much worse than what we had in 2008. Worse in terms of the job losses, worse in terms of the economic GDP contraction, and worse in terms of the monetary response and fiscal response to this, the money printing, the scale of which we just haven't seen before. It was a magnitude more than 2008. So if we look at where we are now, we were sitting around the $1,500 mark in terms of gold before all of this happened. So if gold were obviously to do what it did in 2008 and double or slightly more from here, then clearly would reach an all-time high for the gold price. So if we just look back at what happened last time and think about, while obviously that doesn't mean to say in any way that will happen this time, but if we use history as a guide, we could see a much higher gold price over the next few years.
Right, and as a follow-up question, if we're heading toward potentially that much higher gold price, we can assume that economically, probably the world is not heading in a very positive direction.
Yeah, I think, let's think again about the reasons why gold price was rising. And, I think the main driver behind the rise of the gold price has been the loosening of monetary policy and this move in interest rates principally from already low levels. But, the Fed at one point during the last couple of years was actually tightening interest rates to now obviously dropping those interest rates back to zero. And that does have a strong correlation with the gold price. So real interest rates and gold tend to be inversely correlated. So in other words, when real interest rates are falling, and that's the nominal interest rate minus inflation, gold prices tend to do better because the opportunity cost of holding a zero income asset go up. And so in that particular environment, you tend to see gold prices doing well when interest rates are falling. So the other thing that, the reason why interest rates are falling is, of course, that the economic conditions are worsening. And so when the economic conditions worsen, the government steps in and prints a lot of money, and the stimulus, the monetary and fiscal response is now a sort of established playbook for central banks. And really what that does in the main is it reduces the value of the currency of issue, relative to something like gold. And so when you do monetary printing and you increase the supply of dollars into the market, the casualty potentially is the currency itself. And so, you might make the value of assets increase, but if the value ultimately, measured in the currency is worthless or worth a lot less, that's why people want to protect the value of that particular currency. So they go into gold to do that. So I think we're seeing that principally as well at the moment.
Right, and just a little side question. You mentioned the central banks are kind of operating from an established playbook. I think one thing we're starting to hear is maybe that playbook that they have is not quite right for this new environment. Would you say that's the case?
Well, regardless of whether you think it's right or wrong, I think the precedent has been set, and that precedent is stimulus. And so, when you get, in 2008, remember, people probably forget now, but there were actually some pretty strong reactions to the stimulus from a political perspective. So, if you were more on the left side of things, you were generally much more favorable to the idea of stimulus. If you were on the right, you were probably more negatively predisposed to the idea of stimulus. Now, the shift in terms of the US median voter is much more to the left. And actually on both sides of the aisle, according to recent polling that's been done, the overwhelming of people overwhelmingly favor stimulus. So that means, I think, that actually what we're going to see from central banks is more stimulus and done faster and in bigger amounts, because in many ways it's a policy response that is favorable from both sides of the political spectrum.
Okay, so let's talk a little bit more about the GraniteShares Gold Trust. It's physically backed. It tracks the price of gold. Bars are stored in London. I wanted to ask, there was a rush on physical gold earlier this year, and I wondered if you were hit by that at all. Can GraniteShares Gold Trust investors redeem their shares for physical metal?
Yeah, so the first thing is that it's 100% physically backed by gold. So BAR is the ETF. And the way that BAR works specifically is unlike, there are other products obviously that are backed by derivatives contracts, but BAR is physical gold. So you can only what we call create or redeem, that subscribe or cancel for shares with physical gold. We don't take cash or can't take cash. We can't take futures. We can't take anything other than physical gold. So in that mind, yes, you can redeem. Now, the caveat is you have to redeem in a whole basket size, which is a sort of a round lot. So the minimum for us would be 50,000 shares. But yes, it is possible to redeem that physically. Now, as your question as to what happened in the gold market, then yes, we did see some tightening in terms of liquidity in the gold market. I would say that was largely, or at least more of a factor affecting the futures market, and particularly the delivery here in New York against futures versus the London 400-ounce bar market that we operate in. Now, I'm not going to say that there wasn't concern. It was something that was certainly concerning me, because you had the whole supply chain potentially in jeopardy, from anything from actual miners potentially shutting down to the refiners, which did shut down. Certainly some of the largest ones in Switzerland shut down. And then you had airlines. And of course, one of the ways that, or the main way that gold gets transported around the world is actually on commercial airliners. So there was certainly some concern that that could impact the market. What ended up happening, though, is that the market in London was adequately supplied. And so we got through that particular period. So we didn't see any impact to the fund or to the market more broadly. But obviously here in New York, on the futures exchange and the metal that they have as collateral for some of the futures contracts, they did see an impact. And that's what caused futures prices to trade at a premium to the spot price.
Is your sense that as different places come out from under lockdowns, is your sense that, I guess, blockages in the supply chain are improving?
They certainly are improving. And I think, what was going to happen anyway, I mean, the refineries are back up and online. And, I think that although it would have been, somewhat extreme or certainly unusual circumstances, I think everybody was ready to, make those supplies happen. So whether it meant chartering, private aircraft or other such measures to get the gold from one destination to another, that would have happened to sort of keep the market flowing. But, fortunately, it didn't get to those kind of levels.
Right, definitely. We've seen some innovation in places we wouldn't have maybe thought to see it before. Okay, so I wanted to ask, so the bar ETF, what place would you see for that in a portfolio? I think investors often hear they should have at least some physical gold. So should they have physical gold ETF and physical gold, or would you see it replacing the actual physical?
Well, I'd make the distinction for those that are not 100% familiar, that what an ETF does, it just allows you to own physical gold in a portfolio. So in my mind, it's not there to replace gold coins per se, although people can obviously do that. To me, they're just two different investments. And so our customer or the person who's buying gold ETF, they're people that are managing money in a portfolio. It could be a personal portfolio, it could be a professional portfolio, but they need a way to own gold in that portfolio. And of course, if you have physical gold, you can't do that. So that's the role of the ETF, and that's the role that it plays within the portfolio. Outside of the portfolio, people can obviously buy gold coins, they can buy small bars, but obviously the downside is you can't put that in a portfolio. So I just think they're two different investments. I don't think that they're necessarily in conflict with one another. I just think that our market, that's the investor that's looking to own this as a portfolio or in a portfolio along with other investments that they make. And gold is just, the ETF is a very liquid and efficient way to do that.
Yeah, and that leads into my next question, which is who are you seeing investing in gold right now? You mentioned people might be adding to their individual portfolios. It might be institutions. Who are those people or institutions who are buying right now?
So, obviously with an ETF, it's listed on a stock exchange. So anybody that has access to a brokerage can buy it. So when you get an ETF that's now the size of something like BAR, you get a huge spectrum of investors. And typically you're going to get retail investors or, do-it-yourself investors who are buying through online brokerage accounts. I'd say that probably makes up 20 to 30%, something around that. It's difficult to say exactly. And then the rest are professional investors. So that's managed money. So it could be a financial advisor who is, putting 5% in gold in the portfolio for their clients, or it could be a foundation, an endowment, or a hedge fund, somebody like that. But overwhelmingly, it's institutional investors, but retail investors are going to get bigger and bigger, I think, in terms of as awareness of gold picks up.
Right, we do kind of keep hearing that as that interest picks up, we're going to see more people, more generalist investors coming into gold. So at what point do you think that would happen? What's the milestone we need to have that?
Well, I think the big catalyst, and this is kind of a big debate in the market at the moment, is what's the role of bonds in a portfolio? And so for the longest time, you had this concept of a 60-40. So that was 60% equities, 40% bonds. And obviously that was in a world where, we had interest rates at some level, and that you held bonds because they diversified or helped diversify from your equities and also gave you some income as well. Now, obviously, we're in a situation where we have zero interest rates, so bonds are no longer giving people income. And arguably, at the bottom of the interest rate curve, what room do bonds have to go in terms of performance? And therefore, I think the bigger question is what role do they therefore play in the portfolio going forward? And I'm not saying that bonds will disappear completely. Clearly that would be an extreme sort of thing to say. I just think that if you're looking for a reason or a part of the portfolio that I think where gold will be used, it will be people reducing their fixed income allocation and replacing that with gold. And the reason is because gold is uncorrelated to both equities and bonds. And I think gold has actually acted as a better diversifier. And so I think that when we look at the role of fixed income in a portfolio, I would suggest, or I would think that people would start to evaluate that again and think, okay, well, if I'm going to reduce my fixed income allocation, I might replace that with some gold. And that's maybe where we see or would see the most likely allocation.
Okay, that's interesting. So that is something that people may become aware of at some point in the future, and then we would start to see that possible change.
Yeah.
Okay. Okay, so we've been talking a lot about gold, which I think is fair, but it's not the only ETF product that you offer, the bar ETF. Is there anything you'd like to share about your other ETFs, your other products?
Well, very quickly, I mean, there are really three core parts to our business. So real assets, we've been talking about that a lot, but it's not just gold, it's broad commodities, and we have platinum as well, which is another gold-like investment. Mm-hmm. And then we have income, which our twist on income is a very differentiated strategy. It's called alternative income, and the ticker code is HIPS, H-I-P-S. And what we're trying to do there is generate a very high level of income. So currently, the income is about 12% per annum. And the way that we do that is through a pass-through security portfolio. And pass-through securities are non-corporate tax-paying entities that are required to distribute almost all of their income to investors. So the four main groups would be things like real estate investment trusts, like BDCs, business development companies, closed-end funds, and MLPs, master limited partnerships. So kind of those four segments, we have a diversified portfolio, and that's an alternative way for people to generate income, especially in an environment where they're not getting income from bonds and from equities. A lot of companies are cutting their dividends on the dividend side. So that's an interesting play. HIPS is the ticker. And then the lastly, we have large cap disruptive core equity. And our strategy there is called X out. And so the idea behind X out is that, you know, for the most part, the industry is kind of split into two camps. So you have on the one hand, the active managers. Those are people that believe that they can pick stocks that will outperform the market over the long run. And that's just been proven time and time again to be incredibly difficult to do. And arguably, after fees and taxes, just doesn't work consistently over time. So you've got the other camp that says, okay, knowing that it doesn't work, let's just accept that we can't beat the market and we'll just buy the market. And that's passive investing, traditional index ETF or index fund investing. And that just says we'll just buy every company in the market, regardless of whether it's a good or bad company. So what X out does is saying, okay, well, through the lens of technological disruption, we know that there are companies that are fundamentally advantaged by technology and fundamentally disadvantaged. And in a broad market sense, does it not make more sense to try and identify companies that are disadvantaged or struggling and X those out of the portfolio, then try and focus on picking or finding the next Google? And so empirically, we think that it's actually easier to identify a loser than it is to pick a winner. So the idea is that the way to potentially outperform the market over time is not to focus on winners, because actually the stock market is driven by only a few stocks anyway. It's actually to focus on eliminating the losers. So potentially what's more important is what you leave out of your portfolio than what you put in. And that's the genesis behind X out.
Okay, it's almost a little bit of a contrarian approach to it. One small follow-up question. Can you give an example of a company that's been X'd out?
Yeah, there are lots of good examples. And ones I think that people will sort of intuitively think make a ton of sense in this particular environment. But I would say that oil and gas would be one big sector, and real estate would be another big sector. So companies like Exxon, companies like Chevron, even companies like Coca-Cola, which a lot of people, everyone knows what that company is, but in an age of digital disruption, their physical distribution or reliance on physical distribution networks, has been an issue. And not being able to sell your product in bars and restaurants, you're going to be affected like everybody else. And so really what X out does is we score every company. We take the 500 largest companies in the US by market cap. We score every single one on 7 fundamental metrics. Then we eliminate the 250 with the lowest scores. So it's completely rules-based, emotions completely taken out of it. All we're doing is just looking to eliminate those companies with the lowest scores. And I think that's kind of what's so interesting about it, because people look at the top 10 danger stocks, the top 10 X outs, and they think, oh my goodness, why have you X'd out Walmart, or why have you X'd out Exxon? And we have to say it's completely rules-based, unemotional. It's just what the model is telling them based upon these inputs. And I think so far people are really resonating with that story.
Okay, well, that's great. I think we can leave it there for now. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Will Rhind with GraniteShares.